Good afternoon, traders and investors. Will back here with another one, coming to you with a Saturday video, guys. Hope all of you are having a very good weekend so far. And in today's video, guys, we're going to be taking a look at some subscriber requests. We have about 12 to 13 names that have been provided by you guys over the course of the last few weeks of trading. So my goal in today's video is to go over each one of these requests for about 3, 4, 5 minutes each, during which we're going to cover some very brief fundamentals around the company, very brief technical analysis on the company as well, and lastly, my input as to whether or not I would like to buy these companies or if I'm going to stay away. Now, keep in mind, guys, even though I will be doing analysis on these companies, none of this is financial advice to any of you, only my single opinion on these companies. So without further ado, guys, let's get right into it. So request number 1 is going to be coming from Ed. Thanks. Maybe Carvana for the viewer picks video. Sure, Ed, we can definitely take a look at Carvana right now. So let's give a little bit of backstory as to Carvana's price action, right? They obviously had a tremendous rally after the post-pandemic era, just due to the fact that interest rates were near zero. So it's very easy to obtain financing for any used vehicles, and also a lot of stimulus money too. So people were out there spending it on cars. They had a tremendous rally. And unfortunately, then 2022 came around, very high inflation, very high prices for new cars, and very reduced inventory after everybody gobbled up all of the supply. This led to record losses of free cash flow and net earnings, and pretty much put the company very close to bankruptcy in the bottom half of 2023 before they started their substantial recovery here, almost a 25x from the bottom currently. However, guys, Carvana, you have to be very careful with this company, in my humble opinion. They have been accused over the last couple of years of, in other words, cooking the books. Their accounting practices are very, very shady, guys. And the gross profit that they report per vehicle is, by a large margin, beating the rest of the industry. And this has been an industry that's been around for a very long time. People usually know the average margins per vehicle sold, and Carvana is beating its peers by such ridiculous numbers that it begs the question if it's actually even financially possible. Keep in mind, they have not been externally audited for over a year and a half right now. So, you know, they do report internal accounting, of course, but they do not report GAAP recognized accounting principle reports, right? So that is very unfortunate for them, and it just doesn't lead to a lot of transparency for investors. Here are my concerns, and they are voiced best by this Seeking Alpha article. Are the headline numbers too good? This has been a concern for the company over the past 2 years, which is why to be quite honest with you guys, I've just stayed away from this one. So let's take a look at Carvana's gross profit per vehicle sold and then compare it against their peers. And you'll see, guys, it's kind of fishy, right? So Carvana's gross profit per vehicle sold is listed at about $6,200, which is very, very large. The National Automotive Dealers Association says that the national average is usually about $2,300 across most dealers. So Carvana is almost beating the national average by a 3x. Let us compare them against some of their peers, very established peers, such as the names as CarMax and AutoNation. So let's take a look at CarMax. How much does CarMax make per vehicle sold? So you can see down here, CarMax makes about roughly $3,606 of gross margin, which is 60% lower than Carvana's $6,200. That's for CarMax, one of the largest retailers in the entire nation. Now, moving down, take a look at AutoNation, another one of their very large competitors. AutoNation, everything included, so the sale of the vehicle, possible financing on the vehicle, and extended warranties and excessive service packages too, $4,200. Still well below Carvana's profit of $6,200. And when they ask Carvana, how are you guys able to generate such market-beating returns? They say, well, we use proprietary algorithms to determine which cars to bid at auction and how much to bid. Our software sifts through 100,000 vehicles per day and filters out vehicles with poor condition ratings or unacceptable attributes. Well, guys, you know, the rest of the industry does the exact same thing. So from Carvana to be able to say our algorithm is so much better than anybody else's that we can generate 40 to 60% plus gross margin in excess of our competitors, that is quite large, guys, in an industry that really, you can't really have any new sauce, as they say, to this industry, right? It's been around for a very, very long time. Now, The bottom line is right here. Adding it all up, here's where it gets a little bit fishy, right? It's a giant mystery to me how Carvana can possibly squeeze out $6,200 of gross profit if their average selling price is under $24,000. That basically implies they're able to buy a car at auction or from consumers for 15 grand, pay all the costs, auction fees, transport, reconditioning, and then somehow collect close to $24,000 on every car sold. It's a 44% markup from its all-in cost. It's something just, as it's the headline says, right? Something just doesn't make sense. And this is a very well-written article. It's one of very many from analysts that are kind of concerned about the accounting practices around Carvana. So in terms of the fundamentals of the business, guys, if you believe what they're saying, well, revenue growth is still slated to be good at 14% per year. EPS growth is 159% per year, but that's just because they're coming out of, negative territory out of this drawdown. And they're saying the company should be EPS profitable at least for the next 4 years worth of time and growing revenue all that while as well, as you can see from these two charts right there. So the fundamentals, guys, do at a first glance look not too bad. In terms of their free cash flow, you can see that, yes, they do generate a little bit of free cash flow, but still have about $6.79 billion worth of debt. So at least they're able to start generating some free cash flow, and the business is turning a corner to profitability. Now, in terms of the valuation here, guys, at $156, they get a forward PE ratio of 339. A forward PEG, when we divide this PE by their growth rate, we get a PEG ratio of 2.13, which is still high. Anything above 2, guys, is relatively high for right now, right? And also in terms of the fundamentals right now, guys, in terms of the technicals, well, the technicals, you just have to notice that it is a clear monthly uptrend, of course, right? So technicals, clear monthly uptrend for Carvana right now, getting slightly into monthly overbought territory. The weekly also looking decent. So if you're looking to play this for more swing trades, guys, just go with the established shelf zones of support, right? Establishing beautiful levels of shelf support right there. So if you're trying to take the bottom, if you're trying to tackle the bottom end of the range for, let's say, a swing trade, then very simply, your stop loss needs to go a couple of dollars below the bottom end of the range. And we're just looking for the continuation of this weekly uptrend to the upside. So in terms of the fundamentals from me, guys, I would personally never put this company in a long-term portfolio. Their accounting practices are a little bit questionable for me. In terms of a trading ability, guys, trading, you can probably have some decent profits on these stocks as well. However, just keep in mind, guys, always wait for the back test, right? Wait for your higher lows to be established. That usually gives you a better chance of targeting some lows, having a very tight stop loss, and then going for the trend expansion for the business, right? So all in all, that is my thoughts on Carvana. Now let's take a look at stock number 2. So also keep in mind for Carvana, guys, in terms of their ability to generate profit, just keep in mind interest rates are high right now, and the prices of used cars have been coming consecutively down and should probably also be coming down throughout the rest of the year and maybe even early 2025. As we all know, consumers are just not pulling out their money for high ticket purchases as they were just a few short weeks ago or a few short years ago. So a lot of short-term headwinds for the company still. Now moving on for second company, guys. Second company is going to be from Naveed. Can we do analysis on Toll Brothers? Absolutely, Naveed. So let's pull up Toll Brothers right now. And let's take a look at this beautiful company, right? So Toll Brothers, if you guys don't know, they are a luxury home builder. We usually cover their earnings every single time they come out every single quarter, right? Usually one of the more defensive home builders in the game, because as they've been saying for about the past 2-3 quarters, their target consumers are unaffected by high interest rates. They cater to a more luxury, high income client, right? So usually those guys are less affected by any impacts of interest rates to begin with. And also, Toll Brothers does not need to do any discounts in terms of financing for their clients, right? A lot of other home builders, to get people to buy their homes, interest rates right now may be 5-6%. They will actually subsidize interest rates at 0.99, 1.99, just to get you in the door and get the product sold, right? So moving on into Toll Brothers, guys, in terms of the fundamentals of this business, guys, are very, very good, admittedly, right? So in terms of their balance sheet looks very, very decent. Not so much debt in relation to the cash they have on hand and the amount of free cash flow that they bring in on a yearly basis. In terms of their EPS expansion and also their revenue expansion, you can see here over the next couple of years, EPS is remaining somewhat slightly flat and then set to uptick in 2027. So definitely need to have some revisions here periodically, but I see no problem with their EPS other than it being relatively flat. Still a very decent valuation valuation, however, the company is relatively cheap. Revenue expansion also somewhat relaxed here the next couple of years. 2027 should be a blowout year for them, but that's still a large ways away, guys. I wouldn't put too much emphasis on that 2027 number. All in all, it gives them a revenue growth rate of 5.3% per year, which is decent on the lower end, but still decent. EPS growth of 8% per year. In terms of valuation as well, valuation at 130 is not too bad. The PE ratio is about a 9.17. You may think this is very cheap, guys. Well, the home builders have always been very, very cheap. Most of all of them trade between PE ratios of between 9 to about 12, really no more than that. It's a very cyclical business, right? You can see all the way back there, they pretty much did nothing for 2012 all the way through the pandemic, and then they've had their explosion. That's why Wall Street is very hesitant to let the stocks run at a higher multiple, just because it's a very cyclical business. So in terms of the short term, guys, we know what could potentially affect this company, right? The housing market is slightly slowing down right now. Do I have the new housing starts right up here? I think I do have the new housing starts. Here's your United States housing starts chart. You can see it is coming down. So even Toll Brothers, even a solid company that's exposed to more of a luxury client, they will eventually be affected by this slowdown in overall demand. So short-term headwinds, very possibly. However, long-term, they have a lot of tailwinds. We know that obviously in the US, there is not enough housing. So at least through 2030, analysts say that they should have a very nice runway of compound annual growth rate in terms of housing demand. But we know it's not going to be like this, right? It's probably going to be very bumpy to the upside. But all in all, I really like the company, has very solid fundamentals, and the valuation right now is somewhat cheap at only a 1.14 peg. Now, in terms of the technicals of the company, guys, well, you can see right here, right? This is really the zone that you're looking to make some trades out of, right? So we obviously know that we are in a great, nice weekly uptrend right now, trying to find the weekly higher low for possible trend expansion. But if ever it doesn't follow through here, guys, I would possibly be tempted if ever we revisit this location and kind of consolidate a little bit more on the monthly chart, because we know we've had a tremendous run up here over the last 2 years of trading. So I would like to see some sideways consolidation at the top end. And if I can get prices perhaps in the 110 all the way down to 105 level, I may be tempted to make a little bit of swing trades on this company. Because if we can find it down here, guys, very simply, the stop loss goes below here, so about $10 lower, and then we're targeting the all-time highs for expansion. So the risk reward down here becomes a lot better than it is right there. But as of right now, guys, I don't really see any red flags with the company whatsoever. Beautifully moving on the monthly chart, but any sideways consolidation could provide a very nice shelf of support, and we could be able to base more trades down here. So those are my thoughts on Toll Brothers as a whole. Great company, and as you can see, guys, their PE ratio has always usually been very, very low, even over the past 10 years. So it is not an anomaly, despite what some people might think. Now, moving into the next one. So Manuel asking, can we do CCL? Absolutely. So let's take a look at CCL real quick. So Carnival Corporation, guys, obviously needs no introduction. They're one of your largest cruise ship operators in the business right now, along with Disney, Norwegian Cruise Lines, and a few others. And this business, of course, got absolutely destroyed in COVID. But what we seek to understand, guys, is Carnival Cruise finally potentially embarking on a multi-year recovery process. Well, let's take a look at some of their fundamentals, guys, just to have a look right here, right, in terms of the setup of the business. So obviously you can see right here, they had very negative years, 2021, 22, 2021, 22, and now 2023 rounding the quarter, and now 2024, guys, finally starting to recapture a little bit of that net margin positive profits, right? So looking very solid on a forward basis. Take a look at their EPS as well. Went severely negative. 2023 was the transition year, and now 24 through 2027, we are returning to positive EPS territory and also possibly positive net income territory too. Have to give it to the company, guys. They have done a tremendous job at managing costs and not doing too much new capital expenditure while their business was in a little bit of a demand lull. And now finally they are seeing the fruits of that cost-cutting labor. Revenue also coming up nicely over the next foreseeable future, really recapturing a lot of the losses that were made over the past 4 years. Let's take a look at some of their earnings results that they had most recently, guys. And this is from your June 2025. So what happened is they raised the 2024 net yield guidance to approximately 10.25% on continued strong demand. So there it is, guys. Operating margins and yields are coming up in terms of how they're able to utilize their ships versus the demand. So that is doing very, very well. Cumulative booked positions for the remainder of 2024 continues to be the best on record in both price and occupancy. Very good for them. Congratulations to Carnival Cruise Lines turning around their business. Total customer deposits reached an all-time high of 8.3 billion, surpassing the previous record by 1.1 billion. So the business is doing very well right now, capitalizing on that surge in travel demand. And here's what the CEO had to say. Based on continued strong demand trends, we are taking up our expectations for the year, with net yields now forecasted to top 10% and propelling us towards double-digit returns on invested capital. Very strong. On our upwardly revised guidance, we will be on average around 2/3 of the way to achieving our 2026 sea change targets after just 1 year. Those targets are basically all around the operating efficiency of the business. They're doing very well against those, by the way. With 2 years remaining, it certainly gives us even more conviction in achieving those deliverables. So the business doing very, very well. In terms of bookings, the company continues to experience strong bookings, momentum driven by record booking volumes for 2025 sailings, even through 2025. While still early, the cumulative advanced booked position for full 2025 is even higher than 2024 in both price and occupancy. So looking very good for the remainder of the year and through 2025. And now look at the financing and capital activity. So the two main focuses of this company, as I've labeled right here, you need to focus on their demand, which we've just seen is good. Number two, the debt pay down, because that is the largest red flag with the company. They currently have a lot of debt, which they pretty much took during the pandemic, right? They had barely any revenue, so they needed to have a lot of debt to support their business so that they wouldn't go bankrupt. At least a lot of this long-term debt has very long duration maturities, 2030 onwards. So it's not as if all of this debt is due right away. Let's look into that debt as well. So our second quarter refinancing, repricing, and debt prepayment activities are all aligned with our path to investment grade as we continue to manage down debt and interest expense while reducing the complexity of our capital structure. During the last 15 months, we prepaid 6.6 billion in debt, which saves a significant amount of interest expense over time while reducing our secured debt by nearly 40%. Looking forward, we expect substantial free cash flow driven by our ongoing operational execution and the lowest new build order book in decades to deliver continued improvements in our leverage metrics and balance sheet. Lowest new build order book means that they're just not building any new cruise ships right now. They're saving money and paying down debt. So these transactions simplified the company's capital structure. They'll reduce net interest expense by 55 million in 2024 and 85 million on an annualized basis. Very good. So the company ended the quarter with 4.6 billion in liquidity. Here is your term to maturity on long-term debt. Very important here. The company's outstanding debt maturities for the remainder of the year, 2025 and 2026, were 1.2, 1.7, and 2.8 billion. So they do have enough cash right now to at least service a majority of their debt that comes to term in the next 3 years. So the financial position of the company, guys, is looking fair. Now, moving into the valuation, revenue growth here, 4.8% per year. Decent, but definitely not what it was back in 2017, 18, 19. EPS growth per year, 25.2. That's very good, but they are coming off negative, right? So just remember that, which gives them a forward PE at $15, about 12.71. Quite cheap in the grand scheme of things. And if we divide this by their EPS growth rate, we get a peg of 0.5. Very cheap for this company indeed. I would be willing to give them a chance down here, especially due to the fact that we are coming into a very large area of support, which has been in effect since 2020, as a matter of fact. That is pretty much $14 down to about $11. Very decent opportunity, guys. If you want to give this company a long-term chance for a bit of a long-term swing, think maybe the next 1, 2, 3 years as they embark on the recovery story, or maybe even for some short puts, right? Just writing short puts down here. Possibly if you get a sign, just waiting for that bounce, could be a decent little area for some swing trades, even if you are targeting the upside reversion of the company, guys. They're trying to set a monthly bull flag in effect and possibly pop higher. And you know, when you have performance from the competitors like Royal Caribbean, right? Royal Caribbean, give me a second, I forget their ticker, RCL, not RCH. Royal Caribbean has been performing very, very well, right? So CCL may just be lagging behind its competition ever so slightly. The valuation is cheap and the technicals do look good. So I would consider this one for a little bit of a swing trade, right? Now, obviously it's not as solid like a company as Microsoft, right? But still a decent play that has been oversold right now. Not looking too bad. Now, the next company we're going to be taking a look at, guys, is from RKC, DFOR. He's going to ask us to take a look at CAT. So Caterpillar, no problem at all. Let's pull up Caterpillar right away. And Caterpillar just had their earnings just last week or a few short weeks ago. My mistake. Coming out of a very nice area of support. So quick overview of the company, guys. Caterpillar, very, very defensive stock. You'd be hard pressed to find any red flags with this company at all, except for the fact that right now they're operating in a high interest rate environment. And obviously a lot of their machinery is anywhere between, let's call it $300,000 to over $1 million, right? And most of that is bought on financing. And with unfavorable financing conditions right now, the revenue has really declined a little bit over the past year. And that has been the same thing that John Deere has said as well. Let's jump into some of the fundamentals of the company, right? So you can see that their profit margins, although their revenue over the last couple of quarters is either flat or slightly declining, their profit margins have never been higher, guys. And that has just been a byproduct of them being able to raise prices considerably over the last 2-3 years with inflation. And we'll take a look at their earnings call. And most of the gains or maintenance in revenue is not due to demand remaining the same. It's due to prices offsetting the lower demand right there. So fundamentals of the business there are fairly good, decent profit margins right now. In terms of the balance sheet, right, it's not an A+ balance sheet. They do have a lot of debt, but still, they bring in a lot of free cash flow per year and do have a decent amount of free cash or cash on their balance sheet right now. So the balance sheet gets about a B+, B, maybe just a B for me. No major red flags, but still got to watch that debt load. In terms of their expansion, EPS expansion over the next couple of years, decent, although it's kind of flat here, 2024 and 25, should be getting better in 2026, but at least they're not losing EPS, right? So very good chart nonetheless, and revenue as well. Even though revenue is said to be flat in 2024, and maybe even 2025 as well, 2026 should be getting a little bit better for the company. So let's move into a few metrics from them, right? Key thoughts, here is this directly from their earnings. Key thoughts as we look ahead. 2024 full year sales and revenue to be slightly lower than 2023. Now, expect a slight reduction in machine dealer inventory in 2024 as well. Expect 2024 full year adjusted operating profit margin to be above the top end of the target range. Once again, that is due to their ability to raise prices, even in these markets right now, right? Second half of 2024 as well, we're going to be expecting changes of dealer inventories and machines to have a nominal impact on the second half of 2024 sales and revenues. Why that's important, guys, is because if you want to see more demand, you want to obviously see dealers requesting for more vehicles and building up that inventory. When you have a period that demand is low, you'll see very, very small inventory. So the reason we look at guidance, especially for dealer inventories, is are dealers starting to stock up more and more because they start seeing more demand in the pipeline? And so far, the answer is no. So pretty much here, guys, right? 2024 is going to be a flat year, both for inventories and also for overall sales for the company. So that is pretty much your guidance. So far, we don't have any guidance for 2025. So going to be a transition year for them, none just the same, right? Now, in terms of the fundamentals of the business, really no red flags other than that consumer slowdown right now and even business slowdown too. So in terms of the fundamentals, guys, forward P at $343 is about a 15.5. That's kind of historical. That's kind of with the historical averages of Caterpillar right now. Let me see if I can actually pull it up here. Let me just pull up the Caterpillar P ratio. Sorry, guys, I had it up, but I think I closed it right here. So let's do this live. So their PE ratio, right now at about 15. Even their forward one is slated to be roughly about a 15.5. That's really in line with what they had historically with the company, right? You can see right here, historical PE, the bottom chart right there. You can see it's always in the mid-teens, right? Always in the mid-teens, except for their blowout years in 2021 and 2022, of course. But right now, it is fairly standard for the business. Now, when we divide that PE by the EPS growth rate, we get a peg of 2.92. But I've always told you guys, right? I'll still do the peg, but I want you guys to know when when we can do the peg. You can really only use the peg, guys, if the EPS is growing above 10% per year consistently, when it's actually growing. This one is more of a defensive company that returns a lot of free cash flow to investors. That's why we look at the free cash flow yield, and it is at 5.9%. Anything between 3.5% to 5% for a long-standing legacy business such as Microsoft or Caterpillar or John Deere, companies like that, right? Very solid A-quality companies, right? You usually expect between 3.5% to 5%. Anything over 5%, you usually assume that you're getting a good deal. So at 5.9, it is better than the standard that we're looking for. Now, if you were to take their forward PE ratio, if we were to give them a price target moving forward here, taking in line their historical PE averages here I have the median, we can derive with just by doing a PE multiple explanation, right, or expansion. 16 PE for the forward year, 22.11 is your 2024 ending EPS. Gives them a target price of about 353, guys. So not so much above the current share price, and that's for the end of the year. And you can see analyst targets are anywhere between 353, 464 is a little bit high in my humble opinion. You can see most people here are at a hold because the company right now is pretty much fair value. There's not much discounts to be had here. However, if we do have a little bit of a retrace, I would like playing this area on Caterpillar. This has pretty much been an area of support since the month of February. 327 down about 312. Could be a great location if we pull back in here, writing put credit spreads below here, maybe even short puts, or maybe some call debit spreads for a potential rally back into the 340s, 350s. I would not be opposed to that at all. Company still maintaining a very nice monthly uptrend. Here we have a bit of monthly consolidation range at the top right here, looking quite good. So I would really like to play the support area if ever we get another opportunity. So Caterpillar, yes, I like it for a long-term investment, guys. You can't really go wrong with a company like Caterpillar, right? Some years it'll underperform the S&P, some years it'll outperform, but the company has very high return on invested capital, very decent margins as well. Look at this expansion in gross profit margins and operating margins just through their ability to raise prices, which has increased their net margins as well, right? So profit margins have never been higher at the company. Yes, they're not organic. They don't come from organic demand. They come from price increases, but still, the margins have not been higher at the company, looking very good, and they do buy back a decent amount of shares per year. This is their amount of shares outstanding on a trailing basis. You can see they buy back a lot of shares, and they do pay a dividend. So this one, very defensive company, does go up over time here, guys. Not one of my favorite picks, but definitely a company to consider if we revisit these lower levels. Nothing wrong with it per se. So thanks very much for that one. Now, moving on, Meet Shaw asking us, please talk about Lumen and MGOL. No problem at all. So let's go over both. Usually, guys, I'll only do one per person, but since I haven't done this type of video in a while, I figured that I should probably do two for everybody who asked for it. So moving on into Lumen, guys. Lumen, if you don't know this one, telecommunications company. They used to, at one point, guys, be a $100 billion company, right? So take a look right now, only trading about $7, right? And this company used to trade all the way up to about 40. Well, they weren't quite a $100 billion valuation, but they were trading up there on a diluted basis. Very, very strong company back in the day, but unfortunately, mismanagement of their multiple lines of businesses led them to have to downsize the business a lot, sell off a lot of lines of businesses that weren't profitable, and really just do a massive reorganization over the past 3-4 years of time, which now apparently is starting to bear a little bit of fruit, right? But this one has really been a company, bit of a company that had a bit of a fall from grace, right? It's been no stranger to the markets. It's been in here since about 1975. Very unfortunate what happened to them, but I digress. So moving into the reasons for the most recent rally, you're probably asking because of this right here, right? Moving up almost, let's call it a 6x, right? 5-6x from the bottoms. So why did it rally, guys? Well, a partnership with Microsoft due to data center implications. They say they have $5 billion in deals secured and $7 billion more in the pipeline. Keep in mind, this is a company who traditionally sells for about $15 billion in revenue per year, and right now only trading at a market cap of about $6 billion. So price to sales is very, very cheap, but let's not forget, guys, right? There's a reason why they're so cheap. They lose money. So number one, what you have to see here, negative net profit margins, and there's no real path to profitability for the company, at least in the next 2 years, unfortunately. Now, in terms of the balance sheet, guys, they've done a good job of shoring up their balance sheet, right? Getting rid of a lot of unprofitable lines of business here. But as you can see, free cash flow does remain a little bit of a struggle here for them on a quarterly basis. And the amount of debt is still quite substantial that they have on their balance sheet versus the value of the company right now, right? So balance sheet still a little bit tricky. And obviously in terms of your future expansion, guys, well, unfortunately, EPS will remain negative for the next 3 years, and revenue will also continue to decline as the company really gets to a leaner portion of the business. The reason it can't generate revenues like up here is because it's sold off pretty much over half of the lines of its business. Now it's trying to run a leaner operation and, controlling costs a little bit more. So they still won't be profitable for some time. We're still restructuring the business to a leaner business, and the assets barely cover the liabilities. Still lots of debt, right? But for most people who are trading this one, you guys don't really care about the fundamentals, right? You want to know, can this one be a 5x, 6x more, right? In my humble opinion, guys, I really don't think so, right? This is where the fundamentals of the business start catching up. Down here, was it oversold? Absolutely. And that's where the discrepancy in price actually was, right? Between the $1 and roughly $3 range. But up here at $6, guys, you're kind of running into where the company is still cheap, but not so cheap that it can actually manifest into a maybe 3-4x. The most that I may be able to see this company go up into, and keep in mind, if there is possibly a short squeeze or much interest from a community like Wall Street Bets and they start loading up on calls and stuff like that, we can probably go higher. But my expectations for the short term is maybe up to this previous resistance level, which is now support, about 10 all the way down to about 850, right? So 850 up to about 1050 might be the terminal range that we're looking at for possibly a continuation of the swing trade, guys. But just keep in mind, this rally is entirely momentum based at this point, right? It was a decent fundamental buy down here. There was a chance for an asymmetric bet, as they say, but coming into these areas, guys, right? Starting to get close to the company's actual fair value right now in these market conditions. You can see that the analysts that cover the stock, right, do have price targets between $4 to about $7, and we're kind of getting up there now, right? So that is pretty much my take on the matter. Could be interesting for some follow through, but be very, very careful how you play this one. I would not be chasing. What you usually want to wait for is the big rally and then pullback, big rally and then pullback, right? When you get the pullbacks here, guys, watch for first hourly oversold conditions. You can see every time they have a good pump, usually they trickle down, people get out, take profits, and then you build a new base of support, hit hourly oversold conditions. You have a better baseline of support to be basing your trades off of something like here, right? Take this rally into consideration, right? Where do we pull back to right here? You're looking for the previous base. Couple that with hourly oversold conditions, you can have a nice trade opportunity in this lower area, targeting the lows below there, because then it invalidates your trade if you're wrong, and then you go for the next leg higher. So that's how I would be looking at this one, looking for the pullbacks, looking for the hourly oversold conditions, putting my stops below recent lows, and then just riding this one higher, right? Pure technical analysis trade. You can obviously trade this one on a multi-day swing or even on a daily swing if you want to go with, 5-minute levels or stuff like that. So I like it for the momentum, guys, but not much more than that, right? Now, moving on further, MGOL. So MGOL, I'll be quite honest with you, I don't really know much about this company. Obviously, it's penny stock territory. The company's market cap is only about $9 million. I really don't trade penny stocks as a whole, guys. I wish I could give you guys some good strategies for trading penny stocks, but because usually we know so little about these companies, it all comes down to order flow. The people who will do best in penny stocks, in my humble opinion, are people who have access to, volume levels and order flow. Those are what you really, really want to be looking at in terms of day trading these companies. These are definitely not ones that I would be holding over multi-day periods, right? You really want to be early when the volume comes in pre-market to one of these moves. That is when, if you can get in early, guys, and it is on your watch list, I would just literally play it with the momentum, right? Keep a relatively tight stop loss and just go for the momentum, because obviously this company has no fundamentals whatsoever. All of these moves, guys, are literally just all short squeezes. But the problem with the short squeezes is you never actually know when they're going to come in. The best you can do is keep this on your pre-market watch list. And if you do start seeing some volume here come in the pre-market, that is where technically you should start taking out positions and just taking your chances for that volume increase. But it requires a very good knowledge of the company's historical volume. So let's say on an average daily basis, the company trades, let's say, 1 million shares, 2 million shares, and then you're looking at it in the pre-market and there's already 4 or 5 million shares traded and the price hasn't moved too much, that's when you might know that you're leading up into possibly an explosive day, right? But as I said, penny stocks, they're not my bread and butter. Obviously, there are people that are much better at trading these ones from me. That's just the way, that's just my humble thoughts on the matter, right? But thanks anyways for suggesting this one. Thank you, Meet Shah. Now, moving on to Minion. Can we cover Baidu when I have a chance? Absolutely. Let's look at Baidu. I haven't looked at this one in a while. If you guys don't know what Baidu is, Chinese company, they're pretty much the Chinese equivalent of Google, right? So let's take a look at Baidu stock right there. So Baidu, Google of China, have it right here. Their fundamentals, guys, are very impressive. Obviously, they're part of the beaten down China trade, but I can't lie, a lot of these Chinese stocks have amazing fundamentals. Talking more specifically about Alibaba, Baidu, and Pinduoduo. Those 3 companies, guys, watch them because they are going to explode as soon as the Chinese economy comes back, starts rounding the curve out of its recession. Watch out, probably these companies are going to absolutely fly. These are very cheap valuations for all of them. So in terms of the fundamentals of this business, you'd be hard pressed to find anything wrong with this company, guys. Very decent profit margins for what the business does. They've now recaptured a lot of the ones that they've lost in 2021 and 2022 as the company went through the Chinese recession. Their profit margins now for the past couple of quarters have been in excess of the high mid-teens, right? So 14, 15%, looking very good there, no problem at all. In terms of the balance sheet looking very, very strong, guys. They've paid down a lot of debt over the past 2 years. Very strong cash and cash equivalents position and a decent amount of free cash flow on a yearly basis. In terms of their growth, well, look at their growth, guys. EPS growth is fantastic over the next 4 years. Revenue growth is fantastic for Baidu as well. Now, taking a look at the valuation, guys, revenue growth, 7.5% per year. EPS growth, 10% per year, which is good. Free cash flow yield, 17%. These guys, Pinduoduo and Alibaba, all have free cash flow yields in excess of 12%, guys. Usually you do not find those type of opportunities in the market, especially not on companies such as these, which are highly profitable, growing very, very fast as well, right? Free cash flow yield at 17% is absolutely phenomenal for this company, and they still have a lot of buybacks, $5 billion by the which is still authorized through 2025, which is 14% of the entire market cap of the company, guys. Very strong buybacks indeed. That's just a result of all their free cash flow. Same thing as Alibaba. Now, moving on to the forward valuation here, their forward P at $89 is only a 7.9. That is the cheapest in the company's history, guys. And their PEG ratio, when we divide the PE by their EPS growth rate, their PEG is only a 0.79. Absolutely fantastic fundamentals for the business, whether it's their balance sheet, their future growth, their free cash flow, everything is absolutely great. Now, moving on to the technicals, guys, well, you should be no stranger to this large support zone right here. It is clear as day, and this is pretty much the 100 down to roughly $75 level. We are actually coming to the lower end of this. I would be very tempted to make an attempt at this company right here, either for a longer term swing trade for the next 1, 2, 3, 4 years, betting on the Chinese economy recovery, right? Or simply playing it as a swing trade, right? Maybe some call debit spreads for some short-term appreciation in the next maybe 1 to 2 months, even some short puts under here around the $80 range, $75 range, and even some put credit spreads as well. So really, all strategies are open to this company. Phenomenal fundamentals and beautiful technicals. This is really where you want to start playing companies, or at least this is where I want to start playing these companies, because obviously none of this is financial advice. So those are just my thoughts on the matter of Baidu. No red flags, great companies, for great technicals for the business as well. So thanks very much for that suggestion there, Minion. Now moving on to Alejandro. So Alejandro asking for Dick's and Crocs. No problem at all. So let's do both of those for Alejandro. Give me a very brief second. And let's get into it. So Dick's Sporting Goods, you guys should all know this company, right? Outdoors. One of your larger outdoors equipment, athletic equipment as well. One of the larger retailers in the United States for now. So they have very decent margins, great free cash flows as well. Strong management team. The management team at Dick's Sporting Goods has to be commended, guys. They are very, very solid and they are shareholder oriented. Most of all the decisions that the company makes is to add value to you, the shareholder, which is one of the main things that I look for in any business. And their store expansion has been going very well over the last few years. They're not opening too many stores to where it's costing them an excessive amount of capital expenditures, which eats into their free cash flow, but they're also not opening too few stores that it shows weakened demand. Their store expansion has been literally perfect, in my humble opinion. The only one concern is, can we have continued outperformance, especially over the next 3, 6, 9 months with a weakened consumer, right? So keep in mind, Dick's Sporting Goods has run a ton this year. Already year to date, this company is already up about 54% year to date, so well beating the SPY. Now, in terms of their earnings, guys, their earnings were absolutely fantastic, right? So their last quarterly earnings, we got them a while ago at this point, pretty much at the end of the month of May. Their next earnings, we'll cover them on the channel, is only in the early part of September. So let's take a look at a bit of what they had to say, right? So they raised their 2024 outlook right there. Net sales up 6.2% from the prior year, and double-digit EBITDA margin of 11.3%. Very, very good. And here's your raise, guys. This is why I want to bring attention to this one. Raise 2024 full-year guidance for comparable sales growth to 2 to 3%, up from 1 to 2%, which was the prior expectation, and raise on EPS as well. This raise on EPS, guys, is a very healthy raise on EPS, in my humble opinion. Talking about roughly a 6-7% raise on EPS. That is very, very, very good. In terms of the quarter that they just had as well, extremely good numbers, guys. Nothing bad to say. 5.3% in comparable sales year over year, driven by increases in transactions and average ticket. So not only are they getting more people, but the people that buy are buying more as a whole. 25 million active scorecard loyalty members, which generated over 70% of sales. So they have very, very good customer retention as well. Very solid company, guys, and they gained significant market share over the last year. Now about 8.5% market share as a whole. Extremely solid, guys. Nothing really bad to say about this company at all if you go through their last earnings. The only concern is, as I said, moving forward, right? Their last earnings were good, but consumer discretionary spending has really starting to been getting hit June, July, and now August. So very curious to say what they say, how this quarter has been for them. Should be quite good because it's a summer quarter, but I want to hear their guidance, especially going into the fall and winter seasons with a weakened consumer right now, right? So in terms of the fundamentals of the business, nothing bad to say here, guys. In terms of the financials, right, you can see they generate very decent profit margins, nothing to really scream home about, but their profit margins are very good, ranging anywhere from low single digits, 7, 8, 9, to some quarters over 10%, right? Take a look at their, if you want to take a look at their net profit margins right here, let me just pull it up real quick. You can see that profit margin evolution. You'll see right here, it used to be gross about 30%, big boost after the pandemic, and now they're finding an average floor, still higher than where they were before. Operating margins also the same, finding a new floor slightly higher than the best their business was doing 10 years ago, and net profit margins still the same, but you can see net profit margins trailing back, but now still in the high single digit number, still a lot better than they were generating back then. I would tend to argue that once again, this is a result of increases in prices that are still lasting through to today, right? So that is why they've been able to improve their operating efficiency right there. Now, in terms of their buybacks, they do a decent amount of buybacks. You can see here, they started a lot of buybacks, then had to issue a little bit of shares right here, and they've been buying back those aggressively ever since they had to issue. Still very good profile in terms of the shares outstanding. And now let's dive into their growth. So we know that their balance sheet is really not a problem either. So in terms of their debt, not that much debt, guys, decent amount of cash and cash equivalents, decent amount of free cash flow per year versus the amount of debt that they have, only 4.26 billion. And even in terms of their EPS and revenue growth, right? Good EPS growth for the next 4 years, nothing bad to say, and very decent revenue growth for the next 4 years as well. Now, let's dive into the valuation, guys, because we know this company has ran a lot. They're sitting close to the all-time highs. So is it a good value proposition to be buying here? Well, revenue expansion, 4% for the foreseeable future. EPS growth, only 7%. That gives them a forward P at 225 of about 16.3. 16.3, guys, is, a little bit high in terms of the company's historical average, but, well within historical average norms, right? That's usually what they trade in when they trade at their highs, about 16, 17. So I don't really see any anomaly right there. That's standard, but it is at the higher end of the range. Now, that gives them a forward PEG ratio of 2.32. Just divide this by their EPS growth rate. We get a PEG of 2.32, but as I've said, companies that have under 10% EPS growth on a consistent basis, the PEG is usually not the best metric to evaluate these companies. You'd want to look at something like a free cash flow yield, and at 6.2%, it is better than the industry standard. Usually you want to find when companies are trading at discounts, you can usually find free cash flow yields between 3.5% to 5%. So at 6.2, it is beating what we would usually expect the better side of your average should be, right? So not too bad there at all. However, my concern, guys, is that this company is almost fully valued right now, right? If we take in consideration their possible growth for the future, right? Their forward 24 EPS is about 13.81. Well, if I give them a 17 price to earnings for next year, right, which is the higher end of their multiple, that's pretty much 234.77, which is literally the share price right now. So we can't really expand the multiple too much. And as I said, with the continued outperformance concern because of a weakened consumer, is Wall Street really going to allow the multiple to expand much more than a 16-17? Probably not, which is why most of your analysts are sitting right here at the average of about 243, which is not too much higher from the current share price. Now, where we could potentially find some discounts is if the company posts lackluster earnings, people get scared about the growth of the company, and we can maybe find some discounts back down here in the 190 range. This is the area that I do think it's a better buy in terms of technicals. Every time we retest this region right here, 190 down to about 178, investors and institutions have found value enough there to be able to bid up the share price. So I would be patient with this one, Alejandro. I like the company, but it's just not the right timing for me. I know you asked me for it a few weeks ago back here, right? So I apologize for that. Back here, if we can find the company under $200, it is a decent bid right now, but I think you may be able to find better pricing after possibly this quarter's earnings or maybe even next quarter. So it'll be on my watch list for the next 3 to 6 months. Wouldn't be my first pick in terms of a retailer, but you know, just because of the valuation, right? It's a very solid company. The management's good, no real red flags whatsoever, but it's just kind of fully priced right now. So if you want to take it for a longer term opportunity, you need to try to find some better pricing. And that's just, you know, my thoughts on this company as a whole. Now, moving into the next one from Alejandro, Crocs, no problem at all. So let's do Crocs right now. So Crocs, such a phenomenal company. This is another company, guys, where the management team is just so darn strong, right? They do have a very good product as a whole, but the product is really helped by a management team that focuses on the shareholder, exactly like Dick's Sporting Goods. They really put big emphasis on maximizing operating efficiencies, bringing in free cash flow, buying back shares, and returning that capital to you, the investor, through those share buybacks, right? Extremely efficient company is Crocs. Now, let's take a look at some of the fundamentals of the business, right? So moving on down, they really capitalized on the direct-to-consumer fashion trend ever since the early days of the pandemic, right? So this company really took off significantly after the pandemic, really blowing up across social media and everywhere, right? You guys know, famous meme, put the Crocs in sports mode type of thing, right? There's just been so many memes around this brand. A lot of celebrities, a lot of influencers have been wearing them and everything like that in the past couple of years. Really led to an explosion across the brand. And the company really has capitalized on that explosion. From the revenue explosion, they've been able to pocket a lot of profits, and pocketing those profits have done a lot of buybacks to return that capital to you, the investor, and increase their share price. Great advertising and brand awareness since that 2020 boom, strong management team, as we said, and focus on operating margin expansion and the cost control of the business. Let's take a look at their most recent quarterly earnings, which came out pretty much August the 1st, so not too long ago. Here's what the CEO had to say. Based on the strength of our second quarter, we are lifting our operating margin and earnings per share outlook for the fiscal year while maintaining our revenue guidance. Our terrific cash flow generation provides us the flexibility to reinvest in our business, pay down debt, and repurchase shares. So that's pretty much, he summed it up, guys, what this business excels in doing as a whole. And no consumer slowdown voiced by Crocs. I went through this entire earnings release and through a bit of the highlights of the earnings call, and there was really no hint at any consumer slowdown by them. Take a look at this business at a glance here, guys. Year-over-year revenue growth of 11%. Very, very, very solid, right? First time as a top 10 brand, overall fashion brand on Tmall during the Midsummer Festival in China. That is huge for them, guys. International expansion has really been a highlight for this brand. 22% international brand expansion, and China grew over 70% on top of triple-digit growth in the preceding year. So looking extremely strong. Their international expansion has really been a highlight to their brand as a whole. They also have a new brand here for the past couple of years called the Hey Dude brand, which is basically kind of some suede, not really suede, but you guys understand that material. I'm not too sure what the material is called, right? But very nice loafers that they make here as well, trying to get another segment demographic going on there as well. So you can see adjusted gross margins are very, very good. SG&A as a percentage of revenue at 32%. That is in line with some of the better companies in the world here, guys. Management does an extremely good job. Adjusted operating margin of 29.3%. Very, very strong, guys. And the metrics just have been going up when we compare them to last year, right? Both on on the Crocs brand, on the Hey Dude brand as well, right? So looking are on both brands as well, which gives them a total brand expansion too. So very, very strong numbers from their most recent earnings. Obviously, we don't have time to go through their entire earnings. They do tremendous buybacks here, guys. Here is your buybacks. That's what they do with all of the free cash flow. Their profit margins have been expanding very, very healthily, as you can see, right? After the pandemic, gross margins are very, very good right now. Operating margins have come up significantly from the lows prior to the pandemic, sitting at a cool 25% right now. And even your net margins for this company to be manufacturing a product, right, and being able to get 20% net margins, better than any time in the company's history, the company is doing excessively well right now. In terms of their balance sheet, as we can see here as well, right, you can see this net profit margin expansion right here. So juicy. Take a look right here. So they took on a little bit of debt here to expand their business in 2022, but they've already started paying it down. You can see they don't have a lot of free cash flow, or sorry, not a lot of cash and cash equivalents, but they will be building that up because they generate so much free cash flow on a yearly basis. So their balance sheet, not too big of a problem in my opinion. Even their growth looks good, guys. EPS growth over the next 4 years and revenue growth over the next 4 years as well. No real red flags for the company. I do kind of like the way this one, I do kind of like the fundamentals of this business. Now, in terms of the revenue and EPS growth, 5% revenue growth for the foreseeable future, 7.3% EPS growth, which gives them a 2024 forward PE at $138 right now, about a 10.76. Not too bad. And if we divide that PE by their EPS growth rate, we get a PEG ratio of 1.47. Even though EPS is under 10% growth, still, guys, they have a very decent PEG ratio, all things considered. Free cash flow yield, 11% almost. This is absolutely fantastic, guys. Definitely market-beating returns right there. Their median PE ratio history is about a 13.5. So they are under their median in terms of historical averages. So if we just do a forward price projection, take this forward EPS right here, times it by the maximum or the median that Wall Street gives them when times are good, and you get a price target of about 160 to about 175 through the end of 2024. Early 2025. And that's also what the analysts are projecting as well. The average is right there at about 160 all the way up to about 190. So the average there about between 160 and 175. Could definitely see some expansion on this one, guys. Long-term portfolio, I'd just be, for the next 5, 10, 15, 20 years, I can't really say I'd have enough confidence investing in this one as I would have, let's say, a Microsoft, because obviously fashion trends change. And it's very tough to say that this company has a moat, but maybe for a swing trade, at least over the next maybe 1 year, could be an interesting position to explore. That being said, if for ever which reason, guys, we revisit these lower areas below the 200 daily EMA, right? So 125 down to maybe about 110. That could be a very nice spot to maybe accumulate a little bit of a swing trade position, trying to hunt for some monthly consolidation in this location right there. All in all, the long-term chart looks pretty good, but if we get a little bit more consolidation because of consumer discretionary slowdown fears, and this company gets dragged down as well, could be an interesting play. As I said, 125 down to about that 110 mark right there. We want to try to get it as low as possible to be able to get that swing trade in effect, right? So very decent play, in my humble opinion. Not for me for a long-term portfolio, but for a swing trade, I definitely do see the thesis here. So thank you for both of those, Alejandro. Now, moving on to Here to Learn, asking for HIMS. Yes, absolutely, HIMS. So HIMS, moving on further. So if you guys don't know what HIMS do, they offer several wellness products. I think one of their products is for, they have two main products, if I do recall correctly. Number one is going to be an erectile dysfunction product, and number two is going to be a hair loss treatment product. Two of the things that a lot of men at a certain age point are very interested in exploring the possibilities of possibly getting their products, right? So Hims definitely catering to a demographic that does need their products. So at least they're selling something that people actually need. Right now, we do have quite oversold conditions as well. So daily oversold conditions on Hims, guys, plus coming into a little bit of a nice area of support. So look at this entire area here, guys, right? From the previous zone where they had their IPO, you can see this big area of congestion, right? Support for the market. You can bring it down a little bit further, but it's just a channel. The idea is you guys understand that it's a range, right? Previous support, previous resistance as well for the markets. Almost resistance. That's why I said you can play with this area a little bit more. 50 cents is not going to change much. So coming down into it now, guys, and what are we looking for right now? We are looking for the continuation of the monthly uptrend. Yes, we're pulling down a lot right now, but this zone, in my opinion, is going to be the zone where you're going to get the biggest reaction from the bulls, which is why I really like it. Yes, if you give back all of this momentum, you are sacrificing the possibility for a V shape, but the bulls can always get this back in a two-step recovery process, which is why I like this area a lot, guys. Just for a technical trade, we're coming into daily oversold conditions into a big area of support. 200 daily moving average is right here. So I would like this one, guys, for a little bit of a swing trade. The company is also coming into profitability. So bankruptcy is not on the table for them. So you don't need, there's no risk of the company really plummeting to zero, right? And in terms of their expansion too, expansion is going nicely. EPS for the next couple of years, revenue expectation over the next couple of years. You can see, guys, the company is growing well, right? And analyst price targets are all above. So this is the exact location where we want to be trying to make some swing trade attempts on this company. So I would be tempted to make some short put plays below $15. $15, $14 seems like a decent area for me on the weekly, and even gauging that monthly pullback as well. Monthly 12 EMA is right there at about 14.5. Could be a very interesting location. And as I said, daily oversold conditions. So if you're trying to trade this for a daily uptrend recapture, two ways of doing it, right? Either this is the daily high or low and they reset. So there is a trade right here, which we can put our stop losses below here. 1473, if we're going more heavy, at least we don't risk losing too much profit. And then if we do get that daily uptrend, guys, TP1, of course, goes at the highs of the most recent move, 18, and then TP2, probably your resistance levels, 1940. So it could be a nice little swing trade for shares right here, or maybe some call debit spreads, or, if you have the stomach for it, some maybe 2-3 month slightly out of the money call options. Haven't checked the premiums on these, but the premiums on these might be a little bit expensive, so be careful on these. But I see no problem at all with attempting a little bit of a swing trade on this company. It actually looks like a very good setup, and I may even try swing trading it on my own in the next couple of weeks. So thanks very much for bringing that one up here to learn. And now, before last, 12 inches unbuffed, we are going to look at LuluLemon and UPS. Yes, absolutely no problem at all. So let's do these companies relatively quickly because LuluLemon, if I'm not mistaken, have earnings in the early part of September. So we'll go over their earnings early September, guys. But essentially what you have to know from LuluLemon, guys, is we covered them last earnings. Yes, they have a low amount of debt, but they have somewhat low free cash flow, and they have a lot of increased competition. LuluLemon back here, guys, okay? So starting pretty much, you can argue 2016 all the way through the pandemic, right? LuluLemon had almost a monopoly. No one was really doing the athleisure trend. They kind of pioneered the entire athleisure trend. The problem is that in 2020, you had a lot of online competitors come on Instagram, on TikTok, and started doing viral brand marketing, started replicating LuluLemon's product offerings and offering them at cheaper prices. And now at this point, guys, you have utmost saturation in the athleisure division as a whole. Now, athleisure is still a current fashion trend, but it is to be argued, how long will that fashion trend remain? We obviously know that fashion trends can last anywhere between 5 to 10 years, but after that, it's anybody's guess whether or not they truly maintain through the test of time. So this company used to have almost an arguable monopoly, and now they have pretty much given back a lot of that monopoly status. Add to the fact that almost none of their competitors have any physical stores, and LuluLemon has a lot of physical stores. It increases their costs, of course. Now, Moving on into the fundamentals of the business. Take a look at their balance sheet right here. Well, in terms of profitability, profitability is fairly good at LuluLemon. As of most recently, they have been dipping a little bit, but it's no stranger to seeing mid-teens in terms of profitability. So that is not a problem for the company. In terms of the balance sheet as well, the balance sheet, have to give it to them, extremely healthy, guys. Way more cash that they have on hand than they do have debt. And the company does bring in a very decent amount of free cash flow on an annual basis. So have to give that to them. It's somewhat low in terms of the market cap of the company, but still decent in relation to the debt that they have. Now, in terms of the fundamentals of the business, in terms of their growth, let's take a look at that growth, guys. Revenue growth of 11% per year, EPS growth of 11.5% per year. But, as we can see here, guys, right? Definitely stark contrast from before, and we will be growing into the future into 2027 as well, and growing revenue into 2027 as well, right? But I would be a little bit careful with these numbers because you don't know how much a LuluLemon's brand is going to be eroded by competition just yet. So these forecasts, I would take them with a grain of salt. They have overall industry headwinds, and those are the ones that I don't really like, guys, right? When you have overall industry headwinds, when you have consumer headwinds, like consumer cyclical slowdowns and stuff like that, that's normal, that's to be expected. But when a company is facing increased competition and there's no real remedy against that competition, that's when I get a little bit nervous. That being said, the company right now does trade at a very favorable valuation. So in terms of their forward valuation, their forward PE at $260 is about an 18.4. That is relatively low in the grand scheme of LuluLemon's history. We've been able to find LuluLemon trading, when they've been trading over here, they were usually trading about 30, 35 price to earnings ratios. So 18.4, it just shows that they've come down a lot. And when we divide this by their EPS growth rate, they're trading at about a 1.6 peg. That's actually not that bad in my humble opinion, guys. So in terms of a long-term buy for the portfolio, LuluLemon, unfortunately, is not for me. I just don't like the fact that they don't have a moat, right? And the fact that they have increased competition that can just replicate their business model without much of the costs of having physical stores as well. So for all those reasons, not a long-term buy for me. But for a little bit of a swing trade here, because we are crushed, I'll be the first to admit, we are weekly oversold conditions right now. We are also coming out of daily oversold conditions as well. And we are also delving into a very big prior area of support, which is the pre-pandemic lows right now between 261 and 228. So swing trade, guys, absolutely, I would do this one all day. And now that we have a base of support to be basing our trades off of, right? Daily uptrend is underway. If we do retrace, that's when we can write put credit spreads possibly under the 230 mark, writing short puts down below here, decent value proposition because we are at big weekly support levels and we are weekly oversold as well. So writing at this baseline of support could be a decent value proposition. And I wouldn't even be opposed to maybe some shorter duration, like 2-3 month away, call debit spreads. I would be a little bit hesitant with some leap call options, guys, because even though the company can have some short-term recovery, there's nothing saying that they can't just hover around these lower levels like they did back here all of 2022 and early 2023, right? So you wouldn't want to take on a leap option and then just move sideways for a better part of the next 6 to 9 months, right? So I'd be careful with the leap options just because of the consumer slowdown that we're having right now and increased competition to LuluLemon, but anything in terms of short-term price action out of oversold conditions, trying to get a bounce maybe to this resistance area now, right? Which is pretty much 294 up to about 275, could be a decent little swing trade proposition in my humble opinion. Now, second, moving on to UPS. Oh, UPS is one that I really like here, guys. Legacy company, UPS. UPS is down trading at levels that they had back in 2018, 2019 as well, right? The pre-pandemic highs as resistance, acting as big support for the company right now. Now, we went over their earnings, guys. If you didn't see their earnings, we covered them on the channel just a few short weeks ago. So I'm not going to be going through a full a full analysis on them as a whole. All you need to understand here, guys, from their earnings is that their business is now at an inflection point. Their unit volumes have hit the lows and are now finally coming into a cyclical uptick. And they do think the second half of this year and 2025 is going to be a lot better than the past 6-7 quarters that they've had. And they've been impacted by wage growth and the union deals coming to an end as well. Those have heavily impacted their EPS over the past 2-3 quarters as they've went through a lot of labor deals and wage increases as well. In terms of the fundamentals of the business, guys, well, UPS Keep in mind right now, their dividend yield is 5% down here. That is a tremendous dividend yield for this company, in my opinion. The company's profit margins have been slightly eroded from the highs of 2021 and 2022, but are still relatively safe, right? Still have very safe profit margins, anywhere between 5 to 6%. Which is what you would expect from one of these logistics distributors, right? Usually that's how much they do generate. Their EPS, as you can see, we have now kind of finding a bottom here in the 2024 transition year, should be doing well moving into the future, and revenue as well should be expanding into the future as well. So it seems as though we're coming out of the end of a cyclicality of the business, and should be better moving forward. That's why on a fundamental basis, guys, I like this company where it is right now. We are finding the inflection point. Obviously, it's tough to pinpoint the exact day of bottom or the exact week of bottom. All you need to understand is in this very long cyclical process that this business sometimes has, right? We sometimes have 2 years of drawdown. Now we are at a bottoming process, which could take some time, but will most likely be rewarded in the long term as the business recovers, right? So that is the moral of the story. It may move slower than expected, but it probably will move to the upside. In fundamentals of the business, only growing revenue at 3.7 per year, expanding EPS though at about 14.5% per year, normal coming off lows of EPS and now back to growth, right? So moving on, valuation at $127, only a 16.7 price to earnings. That is relatively cheap for UPS. Usually you find this company anywhere between 22 to 25. And their forward PEG ratio, divide this PE by their EPS number, is about a 1.16, which is fairly good. The company is very, very cheap right now, guys. Great dividend, decent free cash flow as well, great price to earnings ratio, great PEG ratio, looking very strong. And in terms of the technicals as well, guys, the technicals speak for themselves, right? If we cannot bid UPS at prior multi-year resistance, which is now support, the 200-month moving average is sitting down there as well, right? That is where we need to be bidding the company. If we can't bid it here, where are we going to bid it here, guys, right? So this one, I love, 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 love. I've been calling it out on the channel as well myself over the past couple of weeks. So I will be building positions. Full disclaimer, I do have a position in UPS right now. I will be looking to build a little bit more. Writing short puts, 126, 125 and below. Put credit spreads even below that 125, 124 mark, or even call debit spreads, which is what the trade that I put on here. Call debit spreads, possibly targeting the mid 130s by the month of December, or by the month of November, December, could be a very decent little swing trade pulling up into this area of resistance. Even for a long-term portfolio, guys, this is value at a discount. I would not be surprised if we are nicely rewarded for a longer term swing trade. And analysts tend to agree the average here, even though we got one guy down here at 100, the rest of the analysts, the average is about 145 all the way up to 190. That's a bit too high in my opinion, but 145 back to about 160, that is decent valuation for this company in my humble opinion. So could have some good risk to reward on this stock. And now, lastly, so thanks very much for that. Now moving on to Michael asking for Enphase and BLDR. So we're gonna go through these two quickly. Give me one last quick second. All right, so moving into Enphase. Enphase, we covered their earnings just a few short weeks ago when they had their earnings on the 23rd of July. So if you haven't seen them on the channel, definitely go have a look. Just search for ENPH across my videos and you'll probably find it, because I always put the ticker in the name of the video whenever we do an earnings call for them. I mean, Enphase, nothing bad to say as well, right? So kind of like UPS, everybody knows that solar's been on a downtrend. Consumer demand slowdown because of higher interest rates, right? Not able to sell as many solar installations. And in this case, solar inverters, because of high interest rates, there's just not enough demand. But what we are seeking to find in Enphase are we at a current cyclical bottom for the business, and are times going to be getting better? And what we found in their most recent earnings report is that yes, indeed, we are nearing a cyclical bottom for the company. So this is where we need to be interested in possibly building positions if you like this company, right? So fundamentals of the business, Unfortunately for Enphase, obviously a lot of their profit margins have been eroded in the last few years, but at least they don't have tremendous amounts of debt. They still have decent free cash flow that they bring in on a yearly basis and still have a decent amount of cash and cash equivalents on hand to service this debt. Not a immediate problem for the company as a whole. In terms of their profit margins, they are still profitable, but a far cry of what they were. Usually this company should be bringing in anywhere between 10 to 20% net margins. The most recent quarters, only anywhere between 3 to 6. So really trying to bottom out in terms of the cyclicality of the business. In terms of your growth, you can see 2024 here, big transition year, but 25, 26, 27, when rates come down, they should be back to business as usual, and revenue expansion as well. 2024, very bad year for them, but 25, 26, 27 should be able to recapture a lot of that revenue growth too. So the fundamentals are improving. Now, revenue growth, 15% per year. EPS expansion, 22% per year. But that's obviously because they're coming off a very low point right here and then growing fast. And then obviously it gives us a PE ratio at 116 of about 41.7. Not too bad when we divide that by their EPS growth rate, which is 22. We get a PEG ratio of 1.89. That's really not so bad for Enphase right now, guys. I myself, as I've been saying on the channel for the past couple of weeks, I like it a lot if we can find it in the low 100s, even below 100. I'm not sure that we are going to see it again, guys, but in the event we get another leg of market selling down, consumer fears, recession fears, all that good stuff, if we can find this company below the $100 mark, that is very good value for Enphase, in my humble opinion. As you can see, we're still pretty much working our ways through this support zone right now, establishing very good support at that $100 level. But I always like playing this one when we get close to 100. I like to write puts in the mid 90s, $92, $93 range, because if I get a sign down there, you are most likely going to get a bounce back into this range and you can make some decent profits. Even building a longer term swing trade position in the company that you're willing to hold over the next 1, 2, 3 years and looking for maybe, something like 40, 50, 60% appreciation as the company gets back to its business as usual could be a very decent trade. So I like this one, but once again, we may need to remain patient because just like UPS, the business can recover, but it can take possibly some time before it really starts getting some legs and before investors are certain that the worst is now behind the company. So I like it in these lower levels as a whole. And then lastly, Michael asking for BLDR. So BLDR, this is a very solid company. Thank you very much for bringing it up, Michael. I hadn't really seen this company much before you brought it up, so I did a little bit of research on it, and I really liked what I found. So this company, guys, does respect a criteria that I look for in long-term investments. Very high return on invested capital, very high return on capital employed, both of them over 20%. They would actually make my list that I have right here of high quality compounding predictable companies. This is the best in the industry. Now, they don't really have any direct industry competitors right now. Builders, what they do, if you guys don't know what they do, right? So essentially what they do is they are a contracting wholesaler. So they sell flooring, roofing, windows, doors, stuff like that you would need for either new build construction or renovation construction, right? So let's take a look at some things that they said in their most recent corporate earnings. So while we continue to see weaker than expected, because we need this, guys, for the status of the housing market, right? Because that impacts their business. So while we continue to see weaker than expected single family starts, slowing multifamily, and broader housing affordability challenges, we are executing our strategy by controlling what we can control, investing in value-added solutions, and driving adoption of our industry-leading digital platforms. So they too acknowledge now the slowdown of the real estate market, more specifically, the newer construction market, as you can see right here from the US housing starts, which have been coming down from their peaks of 2022. So even them acknowledge that in their most recent earnings. As a whole, though, net sales were doing not too bad, but a decline from 2023. Net sales of $4.5 billion, 1.6% decrease, right? Driven by a decline, 3.8% decline in core organic sales, such as multifamily, which continues to trend to the downside. So I went through a lot of their earnings report, guys. It wasn't too bad for the most recent quarter, but they do highlight that weakness is starting to plague their business. Within the company's geographies, single-family starts are projected to be up low single digits, multifamily starts down 25 to 30%, and R&R, this is renovations and repairs, flat to the prior years. So you can see the only thing that is still doing well is single family here, guys, but still not, that is not a majority of their business. A majority of their business is still down in terms of their guidance. So that being said, the company may be going through a little bit of cyclicality right now, but in terms of the long term, it really doesn't have any direct competitors. It's one on its own. You could kind of argue that the whole, the pros side of Lowe's and Home Depot could be a competitor to this one. But then again, these guys sell directly to the contractors. They really don't have that much of a retail facing business as a whole. They're entirely wholesale, right? And there's no other public companies. The only other one that I can think about is, I think they're called 8488 Lumber. They do kind of what this company does, but in the market, publicly traded companies, they're really one on their own right now. In terms of the fundamentals of the business, very good, guys. Great free cash flow right now. Take a look at their balance sheet. So look at their balance sheet right here. You can see very good free cash flow, guys. Not that much debt in relation to the amount of free cash flow that they bring on a yearly basis. And quarterly basis, bring in a decent amount of free cash flow as well. Not too much cash and cash equivalents on the balance sheet right now. They utilize a lot of that either to expand their business or to buy back some shares, but good use of capital, guys. And the proof is in the return on capital employed, right? And return on invested capital. Moving into the forecast for their growth, you can see here, 2024 going to be a bit of a slower year in relation to 2023, such as the home builders have been saying as well. And 2025-26 expansion after rates come down, supposedly to stimulate housing demand. Revenue as well, a little bit of a slow year here in 2024, but 2025 and 2026 should be moving to the upside. So all in all, not that bad, guys. Great business, solid revenue growth, 8.5% per year, EPS growth, 11% per year. Now, valuation at 161, decent, 14.45 P ratio. That's relatively cheap, but then again, these companies don't usually trade much higher than a 15, 16, so it's getting close to its fair value right now. PEG ratio at 161, guys. Divide this by their EPS growth rate, 1.31, not too bad at all. And also, free cash flow yield of 8.3%, guys. That is very, very good. And what do they do with all this free cash flow? Well, they've bought back a decent amount of shares over the last couple of years here, guys. I do expect that to continue in terms of the years moving forward as they build up more free cash flow, as they scale the business. This business is still, in the grand scheme of things, relatively small at only about an 18 billion market cap right now. I mean, that's pretty good considering the fact that they sell $18 billion worth of stuff per year. So they're trading at about a 1 price to sales right now. Fairly cheap for the company, gaining market share, gaining popularity with professionals in the industry right now. I can see some very good things for the upside future on this one. And analyst targets as well are still above the current share price, not by much, 165, 182, and 200, right? The company is, for all intents and purposes, fairly valued right now. But in terms of a swing trade upside, well, just look at the monthly nice uptrend right now, bottoming out and looking to go for more. So a little bit of swing trade right now. I don't like that. Our risk to reward isn't the best, right? The reward is all the way up here. So $50 of upside. The risk, however, is about $30 worth of downside. So not quite a 2-to-1. But if we do come down lower into this range, maybe tighten up a little bit here, guys. Could be an interesting location, maybe some put credit spreads below the lows right here. If you can find some decent premium on them, right? And maybe even some call debit spreads leading into the future, guys. But keep in mind, this one is fully valued. So I'd be maybe looking for days like this, right? Where they get big down days after earnings, or the culmination of a long duration sell-off into this range where we get somewhat daily oversold conditions. That's where I would look to take a swing trade on this company. I'd be patient with it. They don't usually move that quickly. So in my opinion, decent, guys, for a very, a medium-term swing trade and possibly even a short-term swing trade as well. Weekly MACD starting to cross over as well. So it could be interesting here if we can get some further consolidation, build some positions in shares, and maybe just ride them up as the stock moves higher, as the cyclicality gets better towards the end of the year and maybe through 2025. That's probably when you're going to see a better ramp to the company as a whole. So that's pretty much everything we had for today, guys. Thank you very much for all of your recommendations. Hopefully, in the brief time that we had over each and one of them, I was able to answer some of the questions or concerns you may have had. And once again, guys, if you have any stocks that you'd like to see, please feel free to leave them down below in the comment section of my Monday through Friday daily market recaps. So once again, guys, thank you very much for watching. If you enjoyed this type of video, consider dropping a like. Would appreciate it for the growth of the channel. Also, consider subscribing to the channel if you're new. Would love to have you back. We do these videos, every couple of weeks. and do the top 5 options plays every Sunday night, and then our Monday through Friday videos of our daily market recaps. And as usual, guys, if you have any questions at all, always feel free, leave them down in the comments, and I'll get back to you in the next 24 hours. So take care, guys. I'll see you tomorrow in the top 5 options play video for the week. Take care and peace.